That's not going to be any different this time around. There's going to be tremendous volatility as we get closer to November. And I think that's a trader's dream, because when you look at the backdrop for our business, for our sector, that is, you've got a very accommodative Fed. You've got $5 trillion already out there with another $3 trillion, that the House is proposing. It's just print money until the cows come home. But it's not just the U.S., it's everyone. If you look globally, it's the EU, it's the BOJ in Japan, et cetera. So everyone's on board. It's like that's the backdrop that you want to see as a precious metals investor.
Thanks for watching this RTD interview. Don't forget to pick up your RTD Scary George round. Now enjoy this interview. Welcome to another RTD interview. Today I'm excited to have first-time guest, Mr. John Feneck from Feneck Consulting. John is an experienced equity analyst as well as a precious metals analyst, and today he's joining us on RTD to share his thoughts on the current environment from an investment standpoint, an analyst standpoint, and you name it. So I'm excited to have John on. So John, welcome to RTD Interviews.
Thanks, Mike. Appreciate it.
Well, I appreciate you taking time to join us. Definitely excited to get a little bit more of an understanding as to what you're seeing out here in these markets, because a lot of people are concerned with where we're at, where we're going, and how to navigate these waters, because we are in unprecedented territory. And so before we dive further into some of the questions, I'm curious to find out a little bit more about you. Can you share with us briefly a little bit of your background and how you've got here in this point in your career?
Sure. So I started in 1992 with Merrill Lynch as an equity analyst, and then went into what we call wholesaling, which is from 1993 until about a year ago, I was acting as an intermediary between mutual funds and ETFs and the financial advisor community. Financial advisors, for your listeners, could range from Merrill Lynch and Morgan Stanley, the big boys, to a planning firm like LPL, to a small firm called an RIA. So I work with all sorts of different advisors. I did that for 27 years. So last year, I attended the Precious Metals Summit out in Beaver Creek. I had 3 mining CEOs approach me and say, hey, you should be a consultant. So I ended up going through a job change around October 1st of last year. Worked last year exclusively with mining CEOs to try to get them to understand my thesis, which is the average financial advisor is extremely bright and has a lot of money under management, but really doesn't understand our space, meaning metals and mining. They might own a sliver of GLD or SLV, but really they don't own Newmont or Barrick or anything in the small and mid cap space. So I think there's a tremendous opportunity there in terms of education. And so my company, Feneck Consulting, does a couple of things. One, it marries those type of financial advisors with the mining CEOs that I'm familiar with. I have a Rolodex of about 50 or so different companies that I work with currently, not on a retainer, but just have a good relationship with, that I built over the last maybe 20 years I've been involved in this sector. And then also I work with high net worth clients, a lot of your listeners that may just be getting their feet wet in this space and have been overwhelmed by the volatility we saw in March, and then the V-shaped recovery that we've seen since then. So I think that I can be of service to a lot of different people, and I've always just tried to be very honest and upfront with people about what I can and can't do. So.
All right, sounds good. So I appreciate you for sharing that with us. And so let's dive right in as far as just get into the bottom of what we're currently experiencing now, outside of the current health situation that caused the fluctuations back in March, and unemployment at all-time highs, and all these very scary statistics that we've never seen or haven't seen since the Great Depression. But yet the equities markets continue to still be going upwards despite all of that. So are we in a new norm in a sense for investors' sake? Is this something that we should get used to, or give us a rundown as to where we're at currently?
So, the volatility we saw in March was unprecedented. I was at my computer a lot in 08, 09. The velocity of March 2020 was at least double, if not triple that. So my personal theory, Mike, is that double and triple ETFs have caused a lot of the volatility in the market. I did a piece with David Erfley, who I have a lot of respect with, who's a Kitco contributor, on April 3rd. It's on my website under articles. and it was about direction and the JNUG and Nugget ETFs that they have, which, as you know, are, at that point, triple GDX and GDXJ exposure. Now they're double. And I tried to enlighten investors about what had gone on through that process. It's a pretty interesting read. It took me about like 9 different phone calls with direction to try to get all that information. And Dave did a really good job of summarizing all that. But that said, that might have been the biggest shakeout in the mining, industry, right? Because if you're watching the screen, and I remember where I was March 6th, GDX closed at $29.40 a share. The next week, you're trading at 25. The next week after that, you're trading at 17. So it's like a precipitous drop. For your listeners, GDX is the biggest, and most liquid ETF in the mining space. So, you lose half of your value almost in literally 2 weeks. Most people aren't up for that, right? I mean, we're talking about, as I mentioned, financial planners are talking about 7 to 8% a year, as a goal. Like, your goal isn't to lose half of everything you're worth. And so that head fake, which we call bear trap, was probably the biggest bear trap in literally, my career. I've never seen anything like it. So then what I did personally was get out of the way. I sold some GDX, I sold some SLB, I sold some things that I knew I was going to get margined out on if things kept dropping. And then, bought those back at, I think USLV around 26, and then again on 40. GDX, I started my position at 19 all the way up to 24, and just recently have been selling some GDX between 36 and 37.50, but I've held all of my silver because it's just still so cheap on a relative basis. So I guess what I'm trying to say is that, my outlook is that was real. March was real, and investors need to be aware of that, because right now I think they're feeling, yeah, everything's good. It's like, that was just an anomaly. No, it wasn't. That was real, and it's going to happen again. So I think within the next 6 months, you're going to have another huge sell-off. And what I hope we'll see is that GLD, GDX, all of the major players in our sector will make higher lows, meaning we're not going to see those lows we saw in March, but we're going to see a sell-off at some point. And if we have a liquidity event like we did in March, nothing is, going to be protected. I mean, everything is still very vulnerable at this point until we get a vaccine, some clarity on the economy, et cetera.
Understandable. Now, one of the things you mentioned is that, the returns on investments. And so you have, you consult a lot of financial advisors and whatnot. And so I've ventured out a little bit outside of the typical audience or commentator that I like to speak with, which are heavy precious metals individuals. And so I want to go out there and get a pulse from those that handle large amounts of people's portfolios, just to get an idea as to what the strategy in this current environment is right now. And the 7 to 8% return on a lot of the fixed income mechanisms and all types of other products out there, I imagine those things will not be able to return those type of those yields for that much longer. And so you mentioned that there could be another correction or dip or whatever in the next 6 months or so. What is it about that time frame that you see, and then how will that shake out more people perhaps?
Sure. So obviously we've got the U.S. election in November, right? So you saw the gaming that took place in 2016 leading up to that, and biotech and other sectors. So that's not going to be any different this time around. There's going to be tremendous volatility as we get closer to November. And I think that's a trader's dream, because when you look at the backdrop for our business, for our sector, that is, you've got a very accommodative Fed. You've got $5 trillion already out there with another $3 trillion that the House is proposing. It's just print money until the cows come home. But it's not just the U.S., it's everyone. If you look globally, it's the EU, it's the BOJ in Japan, et cetera. So everyone's on board. It's like, that's the backdrop that you want to see as a precious metals investor. So that's number one. Every sell-off like we saw today is in the context of a bull market, right? So when you see CDE down today, 9+%, I sent an alert out at 537 a share and said, hey guys, there's a huge seller out there. It hit 601 this morning. I'm buying right here. I mean, I'm thinking longer term on something like that. Some things I'll think in terms of a trade just because of a financing that may be done in a mining company, and there's just a lot of selling pressure, and not going to be like a long-term hold for me. But what I see, going forward is just a really choppy market. Not right now, of course. We're just seeing straight up in the broad market. But that's not going to continue forever. I mean, if you've been doing this a long time like I have, you realize that there's cycles to everything, and our sector is no different, right? So when you looked at the price action from, let's say, beginning of '09 to end of 11, that 3-year period was very, very constructive and positive for our sector. I think we're going to get a repeat of that. I know a lot of people think we're in the first inning of that, rally now. I think we're probably more like in the third inning. I mean, it's still going to be a couple of years to go, but I think that everything is getting faster. You know what I mean? I mean, like when you look at this velocity in March, it's like, wow. I mean, even an experienced person like myself is looking at the screen and just saying, this is crazy, So you have to be able to work with someone, whether it's me or a financial advisor, to guide you through this time, because right now it feels awesome, but it's not going to be like this forever. I think you're going to have people start to realize that the impact of what we've done to our economy is going to be drastic. And, we haven't seen that in the numbers just yet. We're seeing horrible numbers, whether it's non-farm payrolls or unemployment or whatever, but we're not seeing it hit our pocketbook to the point where we're not going out and spending, right? Because the consumer has been leading this rally for 11 plus years, in my view. When the consumer falls, that's when you're going to have to start worrying. And I think that all of this unemployment is going to lead to that. There's a guy that I follow. I used to work with at Merrill Lynch, Dave Rosenberg, who I'm sure you're familiar with. I think they call him the ultra bear. I heard him speak at the Precious Metals Summit last September, and he was calling for zero interest rates. And I was just looking around the room to see what people were, they were just looking at each other like, this guy's nuts, And here we are. So it's like, I really don't think that that a guy like Rosenberg is too far off the mark. I mean, it looks pretty difficult, in my view, for a V-shaped recovery, just going forward.
Yeah. Now, based upon the monetary response and the concept of zero interest rates, and that's something that's being experimented with in Europe and all the issues they're having there. And so does the possibility of zero or lower really alter the game plan moving forward? Because I anticipate, the market will respond positively and everything will still go up. But at what point, and of course this is an opinion, but at what point does the very currency itself become an issue to where trading and investing is very, it becomes skewed because you can't tell the true value of anything if it's artificially being propped up? And so right. Share your thoughts on that if you don't mind.
Yeah. I mean, I'm in the camp that you really don't need any more Fed, dovishness to have gold and miners head higher, I mean, I think right now it's like the sweet spot. The Fed's basically said, I mean, just go back and have your listeners listen to Jerome Powell, October of 18, November of 18. The guy was a total hawk. And then in December of 18, when we bottomed out, if you remember that, I think the S&P was down 19.5%. He went out on the December Fed meeting of 18 and basically was a hawk again. And then he started flip-flop. And that started to happen in January of 19, and he's never looked back. He's just gotten more dovish. And so now if you listen to his commentary last month, it's super dovish. It's like the ultra QE, quantitative easing. So, again, I mean, when investors send me emails and say, geez, I should get out of this, it's tanking. It's like, in the framework of a bull market, it's correcting. It's not tanking. It's like, you have to look at it from a perspective of let's hang in there this time because it's different this time, so if you want my opinion on currencies, it's a little more difficult because I'm in the camp that you could have a higher dollar with a higher gold price. It's like it's happened before. If you look at the 70s, it's not typical. But, like today, you see the dollar down or flat and gold's getting crushed. It doesn't make any sense, right? So, I mean, we're seeing some unusual things. I think what I've recognized is something like TLT, the bond product out there, UUP, which is the dollar, and GLD all trade, as safe havens now. So, on a day like this where the equity markets, broad markets are rallying, all three are down. And that's what you want to see. believe it or not, that's exactly what you want to see. We weren't seeing that in March. Of course, everything was getting sold during a liquidity event. But in a more normal environment, yeah, that those three things are safe havens. They should act that way. And I'm just starting to see over the last maybe 2 to 5 sessions that the mining companies are starting to trade as a safe haven too, which is awesome because they didn't trade like that in March, that's for sure, right? So.
Thanks for watching this interview. If you're enjoying content like this, feel free to become a part of the RTD community by becoming a member via Patreon. All it takes is a monthly contribution of about $5 a month for more great content such as this. Just scroll down beneath this video here and click the Patreon link, and then hit this tab right here to become a member of the team. Looking forward to bringing you more great content. Now, let's get back to this interview. Thanks. So I'm curious to get your thoughts, and I want to transition a little bit into, you've laid the outline of some of the problems, and so the solutions for your person who are heavy precious metals investors. I'm new to the mining space myself, so I've had a chance to connect with some gentlemen on different projects out there, but don't really dive much into it because I'm still learning. But if you were to share your opinion on the allocation of I can't necessarily safe because there's risk in everything, but given the circumstances we're facing in this country as well as abroad, can you share with us the allocation of a model portfolio of some things that would do good in different scenarios that we can probably play out?
Sure. So just so you understand, since 2016, probably call it end of 15, so for almost 5 years, I've been almost exclusively in energy, metals, and mining. So I'm not your typical investor, and I don't recommend that people do that. But I would say that every investor should have 5 to 10% of their portfolio in GLD, which is gold, SLV, which is silver, or some combination thereof. There's other ETFs that you could buy in that space, and I'd be happy to, go through that on a future, presentation. But
now question. Sorry to cut you off. So as far as SLV and GLD, as far as like some physical or some of the ETFs or like how could you?
Yeah. So the physical right now, I'm not up for because the premiums are too high. It's like, I know that goes against the grain, but really, some of these dealers are just ripping people off. So, I think that GLD and SLV as a proxy for gold and silver are okay right now. If people wanted to buy the triple, which again, you really have to see like a March sell-off to buy the triple with confidence, in my view, or you just have to see a breakout in either one of these. Gold has been breaking out for weeks. So UGLD and USLV are the way investors can get access to silver or gold on a double or triple kind of basis. They don't generate K1s either, which is nice. But so again, maybe 10%, let's say, of someone's portfolio in physical metals or the ETFs I just mentioned. And then you want to have a good amount of your equity exposure in the mining space. And how I, classify that is royalty companies would be the most conservative. Royalty companies would be your Franco-Nevadas, your wheat and precious metals, those larger companies that basically are safer plays. Now, they've already run up. If you look at the charts, streamers were the first to go. The second subsector of miners would be the larger cap names like a Newmont or a Barrick, symbols NEM and gold. And so those stocks have also run, right? Because that's what a portfolio manager that I used to represent would buy first, right? They're going to buy the big boys. The third tier within a mining portfolio would be your small to mid-cap players. We call those maybe mid-tier companies. Some examples would include, like what I mentioned, CDE, AG comes to mind, HL, Hecla, a number of different companies in that space that are producing right now. And that's where you're going to get a big bump because we're just starting to see these companies take off. So I think there's tremendous opportunity there, and I'm overweight the small to mid cap space right now for that reason. And then lastly, the fourth category, Mike, for me would be like juniors, which are heavy exploration companies. There's a lot more risk to junior mining. The stocks are very illiquid. If you look at some of the prices that happened in March on some of these names, you'll see it's scary, right? Because it's easy to buy them, not easy to sell them. So got to be really careful with putting on too much exposure in that. And that's one of the things I do with helping clients. And not all juniors are created equal. Some of them are very illiquid. Some are easy to trade.
Interesting. Now, for those that might, so that portfolio there is miners as well as physical metals and whatnot. And
Right.
so if you want to go a little bit broader into something outside of that, is there any other sectors that would be something that has potential in this current environment we're in, or might have future potential that you might be looking at or would throw out there as something to, to further study?
Yeah, so on my website, fenneckconsulting.com, I actually put a disclaimer for the first time about a month ago saying that all of my performance returns are just going long. I don't do options. I don't do private placements. There's nothing, exotic about my return, stream whatsoever. But I said for the first time, I'm thinking about shorting stocks, and I have been shorting stocks a little bit in March and in April. I'm not so short at all right now, anything. Just because the market's running so hot, but I have a short list. And so to answer your question, I've been on 25 or so cruises, and, no one can pay me any amount of money to go on a cruise right now. I think the cruise ships are screwed. I'm sorry to say that word, but I don't know how you work your way out of this, right? I mean, Norwegian Cruise Lines, which is NCLH, I believe, said about a month ago, we don't know if we can continue as a going concern. That rings the bankruptcy bell, right? And the stock went all the way down to 7, I think, and it just closed today around 18. I'm like, based on what? It's like nothing's changed. You just said this, 30 days ago. So, I think there's some interesting short opportunities in that sector. I think there's some interesting short opportunities, unfortunately, in energy, just because I don't think some of these companies are going to make it. I talked to Diamond Offshore, I think, in February, and their IR department was saying they could handle their debt, and then in April they went bankrupt. So, it's like, one of the things that I bring to the table, Mike, for my clients is trying to sift through the untruths of, metals and mining and energy, because there's a lot of head fakes going on, and a lot of people are doing nefarious things and just flat out lying. So, it's my years of experience in trying to sniff that out. I didn't buy what I was hearing from them, and I ended up shorting that stock instead of buying it, and made a lot of money. So I think energy presents a good short in that some of the deep water drillers like Diamond are simply, there's just no way they're going to have to hit the reset button.
Now, well, I'm curious to find out your thoughts on the FANG stocks. And so it looks like everything now is upside down as far as, what's of value and what's not. But yet all the technology companies appear to be doing extremely well because people are locked in and quarantined,
Right.
and all those things like that. And so will there be a turn of the tide eventually to where if we do reopen, we go back out, all those, I think the Zoom today closed all-time high, and all the good things coming from those
Right.
companies there. If we were to reopen, things were to go back to what we used to consider normal, then do those companies, in your opinion, still lead the way? And what's your thoughts on that?
So yeah, FANG has definitely led the way for a number of years now, and here are my thoughts. I can't appropriately value a Netflix or an Amazon. I don't disagree with their business models. I think someone like Bezos is a genius, right? But how do I buy Amazon, as a value investor? I don't know. So I don't. Do I short it? No, because I also believe in what they're doing. And I've been a seller on Amazon for 14 years, believe it or not. So I know the fees they garner from me. I think they make somewhere between 20 and 25% on anything I sell. It's like a giant garage sale on Amazon if you're a seller, but you're going to pay a price. And I think in this kind of environment, that section of their business is going to do extremely well, right? If you're unemployed, you're going into your garage and you're trying to sell some stuff and put it on Amazon or eBay and make some coins. So, I think it's very difficult to short that kind of a name, or for that matter, a lot of these stocks in that momentum sector. But there will come a time, and I look for things like the IWM, which is the Russell 2000, to start breaking down, because when you saw the September-October 18 correction, that was led down by the IWM failing, right? And look at the February correction we just had, it was led down by the IWM. So I'm always keeping my eye on that every day and waiting for that thing to break down, because when that breaks down, that's, to me, an indication to start shorting other things.
Ooh, interesting. Well, I appreciate you for sharing your thoughts on that, just because I was always curious to find out, long future projections on where those companies can take us, because wherever they go, I think everything else will follow, unfortunately. But as we get ready to draw down towards the end of our discussion, the price of metals, gold, silver, based upon all activity, is it good to say they will continue to go up, but will they go up substantially in the way that a lot of people are predicting due to all the global issues we're having price-wise? What are your thoughts on that based upon monetary response, fiscal response? Will we see those type of prices this year, or what? What are your thoughts on that?
I think we could see gold revisit the highs as early as the end of this year or first quarter of next year. And obviously, what does that mean for the mining stocks? That means very good things. So let me explain, if you don't mind. There's a thing called all-in sustaining cost per ounce, which is known as AISC in the mining world. And what that means is a Newmont, a big boy, biggest mining company out there, right? They're all-in sustaining costs, which means what it costs them to take 1 ounce of gold out of the ground, all in, is about $1,000. And you're at 1,700 plus gold, right? So look at the margins. I mean, show me another sector where you have $700 an ounce margins, and yet, analysts still aren't upgrading the stock as much as they should. They've got net debt to EBITDA dropping like a rock. Their biggest cost of doing business is what as a producer? It's oil. Oil's tanking, it's recovered some, but if you're a producer, you're loving oil dropping, you're loving the gold price, maintaining this 1,600 to 1,750-ish kind of range, because you're just going to make money hand over fist eventually. And so my message to analysts is wake up. It's like, look at the future, skate to where the puck is going, as Gretzky used to say, not, look at, what's happening currently. Look at the future of the next, 2 to 3 quarters for mining stocks. It's going to be awesome. So getting back to your question about gold and silver, I think that the price of silver is still very depressed versus the price of gold. We call that the gold to silver ratio. Take an ounce of gold, divide it by an ounce of silver, and that number is around 100 right now. So very stretched historically. It's only gotten this high 3 or 4 other times in history, and every single time silver rallies after that happens. So I'm advising clients. Silver is my number 2 holding in my portfolio right now. I'm advising clients not only to buy silver, but to buy silver stocks, because I think there's tremendous leverage there. One today, AUMN, which is a microcap stock, gold and minerals, went from, I think, 39 to 53 cents in one day. So you can see when you're not hedging production, you get a really big, lift in the share price, just because, the silver community is very interesting. They're extremely bullish right now going into what looks to be a breakout for the metal. So, fingers crossed. But, I'm one of those realists that says I'd love to see $50 silver again, but we've got to get through these different hurdles first, meaning technical resistance at, probably 19 to 20, and then big resistance at 21. If we can clear 21, then we're going to see 25, hopefully by this year or next year. And then a lot of these silver companies that we're talking about, with clients are really going to take off. So that's my take on the metals, the precious metals. As far as industrial metals go, I do follow some other things like palladium and platinum and nickel. I just did a podcast with Bill Powers, which went live yesterday, June 1st, and talked about those industrial metals and how they're getting a tailwind right now as a result of this. Let's cross our fingers and hope that the economies globally recover. I'm not sure how long-lived that is, but there are some great PGM stocks that you can buy. Sibanye comes to mind, SBSW, which is about half gold and half industrial. It's a really interesting combination. So they are the number 1 platinum company, they're the number 1 rhodium company, number 2 palladium company, and a top 10 player in gold. So it's like you get all this in one ticker. It's pretty neat.
Interesting. So I appreciate you for sharing that and elaborating a little bit more in depth onto some opportunities out there. So Mr. Feneck, so can you please point people back to your direction so they can find out more about what you
Sure.
have up and how to stay in tune with you and your writings or whatnot?
Yeah, sure. So it's www.feneckconsulting.com. That's FENECK consulting.com. My email is johnf@feneckconsulting.com. And just send me a note through that and ask any questions you'd like. You know, we have extremely reasonable rates versus a lot of newsletter writers out there that, you know, in my view, aren't providing a ton of value. You know, they're sending something out weekly or some of them monthly. And, you know, as a client, as we talked about, Mike, I mean, you're looking at this, and number one, to me, that's old news. You know, we alert clients as we, you know, work on a trade. So if I'm thinking about going into a name, I'll alert my clients like the night before, hey, you know, this is what I'm going to plan to do tomorrow, and give them a heads up. So there's, you know, not any type of front running or illegal activity whatsoever, which is unfortunately running rampant, I think, in this sector and other sectors right now. So, you know, we take a different approach, and I can't work with everyone. I'm a single person, but I try to help people. If I can't help them, I try to direct them to something else that could help them.
Sounds good. Well, John, once again, it's been great having you on RTD. Looking forward to staying in tune with what you have going on, as well as have you back on down the line and get some more insights as to what's happening out in the market. So once again, John Feneck, thanks for joining us here on RTD.
Thanks a lot, Mike. Appreciate it.